The current live price for PAX Group Inc., trading under the ticker PACS on the NYSE, is $15.68 per share, marking a significant intraday gain of $5.10 or 48.20% at this moment in the trading session. That massive upward swing is the first thing we have to talk about because it completely shatters the recent narrative. The market's expectation for PAX, particularly over the last few weeks, has been one of cautious pessimism, a reaction to the persistent volatility that often follows a fresh public offering in a sensitive sector like post-acute care, compounded by a recent SEC filing extension for their quarterly report. The general belief was that the stock was stuck in a rut, grinding between its post-IPO low and a ceiling around the $12 to $13 mark, with trading volumes suggesting institutional players were waiting for more clarity, specifically around those delayed financials. However, today's nearly 50% explosion in price is the reality check, and it's a powerful one, suggesting an informational asymmetry. Some serious capital got deployed very quickly on news or anticipation that the broader market hasn't fully processed yet. This isn't a gradual sector uplift, this is a company-specific event. What makes this move even more compelling is the context of its peer group. While the healthcare sector, particularly long-term care facilities, is underpinned by strong demographic tailwinds, most established names like the Ensign Group or other providers are not seeing this kind of single-day hyperbolic spike. This sudden violent move suggests either a major institutional buyer has entered the picture, a very favorable development has leaked ahead of the upcoming earnings release on November 19th, or perhaps, and this is the deeper angle, the market is suddenly realizing the true operating leverage of a scalable, centralized platform in a highly fragmented industry. When we talk about individual brokerage accounts and online investing platforms like Robinhood or Interactive Brokers, a move like this generates significant retail buzz, but a 48% move on meaningful volume is driven by far larger accounts than individual self-investing efforts typically provide. Looking closely at the recent stock movement, the stock had been beaten down from its 52-week high, which was above $20, and was recently trading near the lower end of its range around $10.50. The volume on today's surge is critical. It's likely running well above the average daily volume of roughly 640,000 shares, indicating a decisive move rather than just a technical bounce. We're seeing aggressive buying that is blowing through established resistance levels, essentially creating a massive gap up from the previous close. This trading activity is the market effectively recalibrating the company's valuation in real time. Before this spike, the narrative was focused on debt levels, which are notable for a healthcare real estate-heavy business, and the uncertainty around the delayed financials. The expectation was for the stock to remain range-bound until the filings cleared up any lingering concerns. The reality today is that a massive amount of capital is betting that the fundamentals, which we will discuss, are far stronger than the market fear had priced in. This is a classic tension between perceived risk and unappreciated asset value. PAX operates as a holding company focused on post-acute healthcare facilities, professionals, and ancillary services. Essentially, they are one of the largest post-acute platforms in the U.S., with independent subsidiaries managing over 300 post-acute care facilities across numerous states, serving tens of thousands of patients daily. Their revenue stream, which was recently reported in the $3.1 to $3.4 billion annually range, comes primarily from providing high-quality care, funded through a mix of government programs like Medicare and Medicaid, and private insurance. It's a needs-based service, making the demand fairly inelastic, but it's also a highly regulated and labor-intensive industry which introduces operational complexity and cost pressures. Their value proposition, what they offer as an intelligent portfolio, is their scale and centralized management structure, which theoretically allows them to operate more efficiently than smaller independent facilities. This efficiency, if executed correctly, can translate into superior margins. Now, let's talk about the institutional ownership picture, because that is where the real story for a mid-cap healthcare stock often lies. While overall institutional ownership is present, including major names like Vanguard and BlackRock, firms often associated with passive investment in various Fidelity ETFs and Fidelity mutual funds, the recent 13F filings show a dynamic of both increases and decreases, not a unified accumulation consensus. Some big players have been trimming their positions, while others, like BlackRock and Firm LLC, have notably increased their holdings in recent periods. This mixed signal is what contributed to the hold or cautious sentiment among many analysts before today. The reality of today's price move, however, suggests that the institutional accumulation score is about to take a sharp turn upward. Somebody just signaled very loudly that they see a significant near-term catalyst. It forces every investment platform, from Schwab Intelligent Portfolios to a Fidelity Investments account, to immediately reevaluate its fair value models. The future outlook for PACS is highly compelling, directly contrasting with the recent price sluggishness. The primary catalyst, which is likely driving this current buying frenzy, is the upcoming filing of the third quarter financial results on November 19th. The market's expectation was that the delay signaled bad news, or at least administrative headaches that distract from core operations. The reality, which the current price action implies, is that the delay was procedural or technical, and the underlying results, specifically the earnings per share and revenue growth, are going to exceed forecasts significantly. Analysts have a broad consensus price target much higher than the current trading price, with the low-end target often around $18 and the high-end around $32, and an average near $26. This means even at today's inflated price, there is still substantial theoretical upside, which explains the aggressive buying. Furthermore, the long-term opportunity for PACS is tied to their M&A strategy. The skilled nursing facility market is fragmented. Companies that can effectively acquire and integrate smaller operators, achieving economies of scale in purchasing, staffing, and administrative functions, can realize significant value. PACS has shown a propensity for this strategy, and the aging demographics, people requiring more post-acute care services, provide a huge, stable demand platform for decades to come. The risks, however, are just as real and cannot be ignored. The two major ones are government reimbursement rates, which are always subject to political and budgetary pressures, and labor costs, especially for skilled nurses and caregivers. Any unexpected change in Medicare or Medicaid funding or a sudden spike in wage requirements can quickly erode margins in this sector. For those who utilize self-investing platforms, paying attention to policy changes out of Washington is almost as important as reading the earnings report itself. When we consider the major players in this financial landscape, whether it's the robust options available through a Fidelity platform, the specialized tools on Interactive Brokers trading, or the simplified access of the Robinhood app, the core analysis remains the same. A stock's value is fundamentally tied to its cash flow generation and the perceived stability of that cash flow. For PACS, the market has historically valued it cautiously because of the regulatory and labor concerns that plague the long-term care industry. Today, the reality being expressed is that the operational execution and the underlying demand in the post-acute space are generating significantly more cash than was recently accounted for. The tension is between the cautious, historical valuation model that sees high operating risk and the new, aggressive valuation model that sees tremendous, scalable growth in a non-discretionary service. As you think about this tension, I want to pose a question to the active investor community. Comment below what specific metric, whether it's same-store occupancy rate or Medicare/Medicaid reimbursement stability, you believe is the single most important factor for PACS Group to sustain this current stock price appreciation. Your input helps shape the conversation and provides valuable investment help to others. In summary, PAX Group Inc. is experiencing a market-wide re-rating today, evidenced by the nearly 50% jump in the stock price to $15.68. The pre-existing expectation was one of continued consolidation and caution, driven by recent volatility, high debt relative to equity, and the uncertainty surrounding the delayed Q3 financial filing. The reality, as violently expressed in today's high-volume trading, is that a massive positive catalyst, likely extremely strong operating results set to be released this week, is being priced in immediately by institutional buyers. This suggests that the company's business model of leveraging scale in the highly fragmented, needs-based post-acute care space is generating unexpected operational excellence. While the long-term tailwinds of an aging population remain robust, investors must continue to monitor the immediate risks of labor